What if I told you the direction of the U.S. economy in 2026 has already been decided? Not by elections, not by political debates, not even by central bank press conferences, but by math. Picture this scenario. It's early 2026. You unlock your phone before getting out of bed. The dollar index is down sharply overnight. Not a crash yet, but enough to make headlines. Your bank balance looks the same, but the prices around you don't. Gas stations update twice a day. Grocery stores quietly remove discounts. Your bank sends a reassuring message about temporary withdrawal limits implemented for stability. The anchors on television tell you everything is under control. Most people will believe them. They always do. Because this is how every monetary collapse begins. Not with panic, but with reassurance. Not with chaos, but with calm explanations. And by the time panic arrives, it's already too late. This moment is not hypothetical. It's not science fiction. It's the final phase of a pattern that has repeated throughout history with brutal consistency. While mainstream financial media focuses on stock market rallies, job reports, and interest rate speculation, the real story is unfolding somewhere else. In balance sheets, in bond auctions, in central bank vaults. And once you see the pattern, you can't unsee it. Rewind to Weimar Germany in the early 1920s. The country wasn't destroyed by war after the armistice. It wasn't invaded. It wasn't bombed into submission. It was destroyed by arithmetic. Reparations exceeded tax revenue. Borrowing filled the gap. When borrowing failed, printing replaced it. At first, the system appeared to work. Employment rose. Stocks surged. Confidence lingered until it vanished. Now rewind again. America, 1971. Foreign governments started asking an uncomfortable question. Can we have our gold? The U.S. didn't have enough to honor the claims, so the gold window was closed. Temporarily, they said. That temporary decision still defines your money today. Every collapse starts the same way. Chronic deficits. Debt that grows faster than income. Confidence that erodes slowly then suddenly breaks. According to the U.S. Treasury's own data, America's national debt now exceeds $34 trillion. According to the Congressional Budget Office, deficits exceeding $2 trillion per year are locked in for the foreseeable future. Before recessions, before wars, before emergencies. Interest payments alone are on track to exceed $1 trillion annually within the next 2 years. Think about that for a moment. The government is borrowing money just to pay interest on money it already borrowed. That is not sustainable. It never has been. The Federal Reserve stepped in once before. In 2008, when the financial system cracked, the Fed printed trillions to stabilize it. They called it temporary, emergency, extraordinary. 16 years later, the balance sheet is still massive and the system is more fragile than ever. Now look at what's happening beneath the surface today. Bond auctions, once boring, routine events are showing cracks. Foreign buyers, who funded American deficits for decades, are stepping back. According to Treasury International Capital data, foreign official institutions have been net sellers of U.S. Treasuries. China's treasury holdings have fallen to their lowest level since the financial crisis. Japan sells to defend its currency. Oil producers now settle trades outside the dollar system. So who is buying America's debt? Increasingly, it's the system itself. Primary dealers forced to absorb weak auctions. Short-term treasury bills rolling over at higher and higher rates. Emergency liquidity quietly reintroduced through back channels. Pop quiz. What happens when the world's largest debtor loses its largest lenders? Yields rise. Higher yields raise interest costs. Higher interest costs require more borrowing. More borrowing requires more buyers. And when buyers disappear, only one entity remains. The central bank. That's where history tells us danger begins. Now watch what central banks are doing, not what they're saying. According to the World Gold Council, central banks purchased a record 1,136 tons of gold in 2022. Then they broke the record again in 2023 with another 1,082 tons, the largest two-year accumulation of gold in recorded history. China, Poland, Turkey, Singapore, buying, repatriating, stockpiling. They are not doing this because gold is trendy. They are doing this because gold has no counterparty risk. Gold doesn't default. Gold doesn't depend on confidence. Gold doesn't need permission. When trust in paper breaks, gold doesn't ask questions. Think about this. If the dollar system were stable, if the future were secure, if debt were manageable, why would central banks rush into an asset that yields nothing? They know what comes next. Because there are 6 stages to every fiat collapse, and every major currency in history has followed them without exception. First comes unsustainable debt, then monetization, then suppressed interest rates, then currency devaluation against real assets, then capital flight, finally reset or hyperinflation. Every empire believed it was different. Every single one was wrong. Now apply the pattern to the United States today. Debt, locked in. Monetization, already done and quietly restarting. Rate suppression, returning the moment yields rise too far. Currency devaluation, visible against gold, energy, and food. Capital flight, happening through de-dollarization. Which stage comes next? Here's where it stops being political and starts being mathematical. The U.S. money supply exceeds $20 trillion. Official gold reserves sit just above 8,000 tons. At current prices, that gold is worth less than $1 trillion. To restore confidence, even partially, the math requires revaluation. Backing just 20% of the money supply with gold would require prices well above $15,000 per ounce. At 40%, the number climbs beyond $30,000. That's not a forecast. That's arithmetic. Central banks understand this. That's why they're buying now before the reset makes it obvious. And the timing matters. Between 2025 and 2026, trillions of dollars in ultra-low interest debt must be refinanced at far higher rates. Interest costs explode. Political will disappears. The Federal Reserve faces an impossible choice. Raise rates and trigger a depression. Or print and sacrifice the dollar. History tells us which door they choose. They always choose inflation. Quietly, gradually, then suddenly. This isn't decades away. The clock is ticking toward 2026. Most people won't see it coming. They never do. But the warning signals are already flashing for those who know where to look. And once you recognize the pattern, the only question left is whether you act before the window closes. Because when monetary resets arrive, they don't announce themselves in advance. They arrive overnight. To understand where the U.S. economy is going, you have to stop looking forward for a moment and look backward. Because history is the only data set that has never lied. Every major monetary collapse follows the same sequence. Different countries, different cultures, different political systems. Same ending. The pattern does not care who you are. It does not care how powerful you think you are. It only responds to debt, trust, and arithmetic. Let's start with Weimar Germany, because it is the clearest example of how a modern currency dies. After World War I, Germany faced reparations that vastly exceeded its productive capacity. According to official records, the reparations bill was more than 3 times Germany's annual GDP. There was no realistic path to pay it through taxation. The government had 2 options: default openly or hide the default through inflation. They chose inflation. At first, nothing seemed wrong. The Reichsbank expanded credit to fund government spending. The economy appeared to recover. Employment improved. Stocks rose. Industrial output surged. This phase is critical because it is where most people are fooled. Inflation initially feels like prosperity, but beneath the surface, confidence was eroding. Foreign lenders began refusing German bonds. The currency weakened. To keep rates low, the Reichsbank printed more. By 1921, the central bank was monetizing government debt directly. According to historical records, the Reichsbank's balance sheet expanded nearly 20-fold in less than 2 years. Here's the key moment most textbooks gloss over. Hyperinflation did not start when prices exploded. It started when confidence collapsed. By mid-1922, Germans stopped saving. Velocity surged. Workers spent wages immediately because tomorrow's money bought less than today's. By late 1923, the mark was effectively worthless. 1 ounce of gold went from costing 4,200 marks to over 87 trillion marks. The currency didn't fail because people panicked. People panicked because the currency failed. Now rewind to the United States in 1929. The Great Depression is often blamed on the stock market crash, but the crash was a symptom, not the cause. The cause was debt, excess leverage. Artificially low interest rates throughout the 1920s fueled speculation. When credit tightened, the system imploded. Banks failed because assets couldn't cover liabilities. Depositors rushed for cash. Credit froze. The economy collapsed under the weight of its own leverage. What followed was not recovery, it was reset. In 1933, President Roosevelt confiscated gold, devalued the dollar, and reset the system. The dollar lost 41% of its value overnight. Savers paid the price. Those holding gold preserved purchasing power. Now fast forward again. America, 1971. Since 1971, for decades after World War II, the dollar was backed by gold, at least officially. Foreign governments could exchange dollars for gold at $35 per ounce. But by the late 1960s, the math no longer worked. War spending, social programs, chronic deficits. The U.S. printed more dollars than it had gold to cover. Foreign governments noticed. France, Switzerland, and others began demanding gold instead of dollars. According to Treasury records, U.S. gold reserves collapsed from over 20,000 tons after World War II to just over 8,000 tons by 1971. Faced with the choice between default and reset, Nixon chose reset. The gold window was closed, temporarily. That decision severed the last anchor-restraining dollar creation. From that moment forward, the dollar became a pure fiat instrument backed by trust alone. Trust lasted longer than anyone expected, because the dollar was global, because oil was priced in dollars, because there was no alternative. But trust always erodes when debt grows faster than income. Now connect these events. Weimar shows what happens when sovereign debt is monetized. 1929 shows what happens when leverage collapses. 71 shows what happens when gold backing becomes impossible. Each case followed the same structure: debt accumulation beyond repayment capacity, central bank intervention to suppress consequences, loss of confidence, reset through devaluation. Every time. And here's the critical insight. The timeline always feels slow until it suddenly isn't. Weimar inflation took years to build, then months to destroy. The Great Depression took a decade of excess, then weeks to collapse. Bretton Woods lasted decades, then ended over a single weekend. Pop quiz. How long does confidence last once it starts breaking? Not long. Now look at the numbers today. According to Federal Reserve data, total U.S. debt, government, corporate, and household exceeds 380% of GDP. That is higher than 1929, higher than 2008, higher than any peacetime level in U.S. history. According to the Congressional Budget Office, there is no realistic political scenario in which deficits shrink. Entitlement spending alone consumes future revenue growth. Interest compounds regardless of policy. This is not opinion, it is arithmetic. And the central bank response is already familiar. Rates are raised just enough to appear responsible, then quietly suppressed when markets break. Liquidity facilities are reintroduced under new names. Balance sheets expand again. History shows us what comes next. Once the central bank becomes the buyer of last resort for government debt, the currency enters the danger zone. That is the exact moment confidence shifts. Not overnight, gradually, then suddenly. Now think about gold again. During every reset, gold does the same thing. It doesn't spike randomly. It reprices when currencies are redefined. Gold didn't rise in Weimar because it was speculative. It rose because the mark collapsed. Gold didn't surge in the 1970s because investors got greedy. It surged because the dollar was devalued. Gold is not volatile. Currencies are. And central banks know this better than anyone. That's why, historically, gold accumulation accelerates before resets, not after. Central banks didn't buy gold in 1933 after the dollar was devalued. They held it before. They didn't buy gold after 1971. They held it before. History does not reward late recognition. Now apply that understanding to the present moment. Debt levels exceed historical collapse points. Central banks are intervening again. Confidence is thinning. Gold is being accumulated quietly, aggressively, and globally. This is not coincidence. This is pattern completion. And the most dangerous moment in any collapse is not the end. It's the period just before most people realize what's happening. That is where we are now. The historical record is clear. The sequence is established. The signals are repeating. The only variable left is timing. And as we move forward, the numbers tell us that timing is compressing rapidly toward 2026. History doesn't repeat exactly, but it never fails to rhyme. And the rhyme we're hearing now has only one ending. Now look at where we stand today. Not in theory, not in opinion, but in data, because this is the stage where history stops being abstract and starts becoming measurable. According to the U.S. Treasury's own figures, federal debt has crossed $34 trillion. That number alone doesn't capture the danger. The danger lies in how fast it's growing and who is no longer willing to fund it. According to the Congressional Budget Office, under current law, the United States will add more than $20 trillion in new debt over the next decade. That projection assumes no major recession, no major war, and no emergency spending. In other words, it assumes the best-case scenario. Now think about what that means. Deficits above $2 trillion per year are no longer cyclical. They are structural. Even if Congress froze all discretionary spending tomorrow, mandatory obligations and interest expenses would continue rising automatically. This is where the bond market enters the story. For decades, U.S. Treasury bonds were considered the safest asset on earth. Not because America never borrowed too much, but because the world trusted the dollar. Foreign central banks recycled trade surpluses into treasuries. That steady demand kept interest rates low and borrowing painless. That system is breaking. According to Treasury International Capital data, foreign official institutions have been net sellers of U.S. treasuries. China's holdings have fallen dramatically from their peak over a decade ago. Japan has been forced to sell to defend the yen. Other nations are quietly reducing exposure. Pop quiz. If foreign buyers step back, who absorbs the supply? Domestic banks, primary dealers, and eventually the Federal Reserve. But here's the problem. As interest rates rise, bond prices fall. That creates losses on bank balance sheets. We saw a preview of this in 2023 when several regional banks collapsed under the weight of unrealized bond losses. That was not a fluke. It was a warning. The system cannot tolerate high rates for long. And the Federal Reserve knows it. Every time long-term yields approach levels that threaten debt service, something happens. Liquidity appears. Facilities expand. Rhetoric shifts. The message becomes clear. Stability matters more than discipline. This is how yield suppression begins. Not as a policy announcement, but as a response to stress. Now consider interest expense. According to the Treasury, annual interest on the national debt is already approaching $1 trillion. The CBO projects that number will exceed defense spending within the next few years. By the latter half of this decade, interest becomes one of the largest line items in the federal budget. Think about the implication. The government is paying interest faster than it can grow revenue. That is the precise condition that precedes loss of confidence. Historically, when debt service consumes more than 20% of government revenue, crisis follows. In emerging markets, that threshold often triggers default. In reserve currency nations, it triggers currency debasement instead. The United States is approaching that threshold now. This is where 26 becomes critical. Between 2025 and 2026, trillions of dollars in low-interest debt issued during the zero-rate era will mature. That debt must be refinanced at rates several times higher than when it was issued. Even a small increase in average interest rates has an outsized effect when applied to tens of trillions of dollars. This is not linear. It is exponential. Now add the global layer. The dollar's reserve status has been the shock absorber that delayed this reckoning. As long as the world needed dollars, America could export inflation, print dollars, import goods, run deficits without consequence. That privilege is eroding. According to the International Monetary Fund, the dollar's share of global reserves has fallen steadily over the past 2 decades. It remains dominant, but dominance is not permanence. At the same time, alternative settlement systems are emerging. BRICS nations are expanding trade outside the dollar. Energy transactions are increasingly denominated in non-dollar currencies. Bilateral trade agreements bypass traditional dollar channels. This doesn't replace the dollar overnight. It weakens it gradually. And gradual weakness is far more dangerous than sudden collapse because it delays response. Now look again at central banks. According to the World Gold Council, central banks bought more gold in 2022 and 2023 than at any time since records began. This buying did not slow in 2024. Since 2024. It accelerated. Pop quiz. Why would institutions that issue currency accumulate an asset they cannot print? Because gold is not a growth asset. It is a confidence asset. Central banks do not chase returns. They manage systemic risk, and their actions tell you what they fear. They fear counterparty risk. They fear reserve dilution. They fear loss of trust. Gold solves all three. This is why gold buying tends to spike before resets, not after. It is preparation, not reaction. Now consider the Federal Reserve's position. Raise rates aggressively, and the debt becomes unserviceable. Banks fail, markets crash, unemployment surges, political pressure explodes. Cut rates, and inflation reignites. The dollar weakens, capital flees, gold surges, confidence erodes. Continue printing quietly, and both outcomes arrive, just slower. This is the trap. The Fed does not have a good option. It has a least bad option, and history tells us which one is chosen. They will sacrifice the currency to preserve the system. They always do. This is not ideology. It is pattern recognition. Now put it all together. Debt is too large to repay. Rates are too high to sustain. Foreign buyers are stepping back. Central banks are hoarding gold. Alternative systems are forming. The refinancing wall is approaching. These forces do not act independently. They converge. And convergence creates inflection points. That inflection point is 2026. Not because of a prophecy, not because of a prediction, but because the numbers intersect there. Debt service, maturing obligations, political cycles, global reserve shifts. When these lines cross, the system must change. History tells us that change does not come gently. The warning signals are already visible to those willing to look beyond headlines. The bond market is whispering. Central banks are shouting quietly. Gold is listening. The question is whether you are. Because once convergence becomes visible to everyone, it is no longer an opportunity. It is an event. And events do not wait for permission. Here's where it stops being abstract and becomes unavoidable. This is the point where policy choices disappear and math takes over. The Federal Reserve is trapped in a box it built itself. And every wall of that box is reinforced by debt. On one side is inflation. On the other is default. There is no door marked soft landing. Think about the options in front of the Fed. If it raises interest rates aggressively, the cost of servicing the national debt explodes. Treasury auctions fail, banks holding long-duration bonds take massive losses, commercial real estate collapses, credit freezes, unemployment spikes. This is the 1929 scenario, a debt deflation spiral that purges the system violently. If it cuts rates and restarts large-scale money creation, inflation accelerates. The dollar weakens. Imported goods surge in price. Savings lose purchasing power. Confidence erodes. Capital looks for the exit. This is the Weimar and 1970s scenario. If it tries to do nothing, the bond market forces the decision anyway. There is no neutral option. This is what economists call a policy trap, but history calls it something simpler, the end game. Now let's make this concrete. According to Federal Reserve data, the U.S. money supply sits above $20 trillion. According to official Treasury figures, U.S. gold reserves stand at just over 8,000 tons. At current prices, that gold is worth less than $1 trillion. This gap is the heart of the problem. For most of modern history, currencies survived because there was an anchor, gold, silver, convertibility, some mechanism that limited expansion and preserved trust. That anchor is gone. The dollar survives today not because it is backed, but because it is accepted. And acceptance is a psychological phenomenon, not a mathematical one. Once acceptance weakens, the system must restore confidence somehow. History shows there are only two ways to do that. You either default outright, or you reset the system by redefining the currency's value relative to something real. Default is politically impossible for a reserve currency issuer. It destroys credibility instantly. So resets happen instead, and resets require revaluation. Here's the arithmetic that central banks quietly understand. If even 20% of the current money supply were to be credibly anchored to gold, gold prices would need to rise into the mid-5 figures per ounce. At 40%, which mirrors historical reserve ratios before major resets, prices climb dramatically higher. That is not speculation. That is division, money supply divided by ounces of gold. Central banks do this math. Politicians do not. This is why central banks are accumulating gold at record speed. Not because they want higher prices, but because they want insurance against a system they know cannot mathematically survive in its current form. Now, look at the Federal Reserve's behavior through this lens. Every time markets wobble, liquidity appears. Every time yields rise too far, rhetoric changes. Facilities are reopened. Balance sheet contraction slows. This is not coincidence. It is containment. The Fed is not fighting inflation. It is managing collapse timing. Because collapse is no longer preventable, only delayable. This is why inflation never truly returns to target. It ebbs. It flows. But the floor rises each cycle. Prices ratchet upward because money creation is cumulative. Debt never shrinks meaningfully. It is rolled forward. Now think about velocity. In Weimar Germany, hyperinflation did not occur when money supply expanded. It occurred when people stopped holding money. Velocity is the silent accelerant. As long as people believe holding currency tomorrow is safe, the system survives. When that belief breaks, spending accelerates. Prices chase behavior. Inflation feeds itself. The moment people decide that currency is something to get rid of instead of save, the reset becomes inevitable. You don't need wheelbarrows of cash for this to happen. You just need trust to crack. Now add geopolitics. The dollar's reserve role is eroding at the margins, not collapsing. Eroding. And erosion is more dangerous because it spreads unnoticed. Trade settled. Outside the dollar means fewer dollars needed globally. Fewer dollars needed means more dollars returning home. More dollars chasing the same goods equals inflation. This is not ideology. It's flow mechanics. When dollars come home, prices rise. And when prices rise while debt is high, the Fed must choose inflation over default. Always. This is why 2026 matters. By then, refinancing pressure peaks. Political constraints tighten. Global alternatives mature. The margin for error disappears. At that point, the Federal Reserve's choice becomes explicit. Either allow a deflationary collapse that destroys banks, pensions, and markets, or intervene openly, cap yields, print whatever is necessary, and accept the loss of purchasing power. History tells us what they choose. They choose to protect the system, not the currency. And protecting the system means sacrificing the dollar's value. That is the mechanism, not conspiracy, not prediction, mechanism. Now return to gold and silver one more time. Gold does not rise because people panic. It rises because currencies are redefined. Silver follows because it is both monetary and industrial, and because it exists in far smaller accessible quantities. During resets, gold preserves purchasing power. Silver amplifies moves because it is thinner, less liquid, and historically undervalued relative to gold. This is why central banks hoard gold, and why private investors historically turn to silver during late-stage monetary stress. It is not about profit. It is about survival through transition. Now ask yourself a simple question. If you were running a central bank, staring at these numbers, watching debt compound, watching trust thin, watching alternatives form, what would you do? You would quietly prepare. That is exactly what is happening. The mechanism is already in motion. The inputs are locked. The outputs are constrained. All that remains is timing. And timing, as history shows, compresses rapidly near the end. Once the system tips, it does not unwind slowly, it resets abruptly. The warning signals are not subtle anymore. They are mathematical. And mathematics does not negotiate. So what does this mean for you? Not for the markets, not for Wall Street, for your savings, your retirement, your purchasing power. If your wealth exists mostly as digits in a system that requires permanent stability to function, then you are exposed to the exact failure point history warns about. Stocks and bonds assume confidence, pensions assume liquidity, bank deposits assume trust. Those assumptions are breaking down. In every previous reset, people who believed the system would protect them were the ones hurt the most. Not because they were foolish, but because they trusted permanence in a system built on debt. Gold and silver are different. They are not promises. They are not liabilities. They do not depend on someone else's ability to pay. That is why central banks are buying gold at the fastest pace in history. They are not speculating. They are insulating themselves from what comes next. And what comes next is not gradual. Resets never are. When confidence finally cracks, prices don't adjust politely. They jump. Markets don't rebalance calmly. They gap, and governments don't warn you in advance. They react after the fact. Some will say, this time is different. They always do. Every empire believed it was exceptional. Every single one was wrong. The reset is not decades away. It is approaching in real time. 2026 is not a guess. It is where the math converges. Those who understand the pattern will not be surprised. Those who ignore it will be forced to react. This is not about fear. It is about preparation. History has already shown you the ending. The only remaining choice is where you stand when it arrives. Because when the system resets, it will not wait for permission. And by then, the window will already be closed.